Welcome to another edition of Canadian Real Estate Wealth Insider Podcast, your expert resource for investors by investors. Now, here's your host, Joe Rickards.
Welcome, real estate investors. Well, today we have the rare opportunity to hear from a former Canada Revenue Agency auditor as he blows the whistle on CRA's ruthless ant attack that's knocking off thousands of real estate investors across Canada like flies, or should I say ants. He's going to reveal some surprisingly simple techniques that you can use to protect your real estate wealth. And as a surprise bonus to CanadianRealEstateWealth.com subscribers, he's going to give away complimentary accounting and tax consultations. Welcome, Surinder.
Thank you, Joe. It's my pleasure to be here.
Okay, now I know we've got a lot to cover here today, so let's get the show on the road, shall we?
Sure.
Okay. Start off by telling us a little about your background and your tax expertise.
Well, Joe, I used to work at Revenue Canada, and I'm a former Revenue Canada auditor, and my job was to specialize in auditing real estate investors and developers.
Can you describe for us in layman's terms, I mentioned ant in the introduction, what exactly is CRA's ant argument that in many cases financially is ruining Canadians across this country?
Sure, Joe. Basically, the ANT stands for Adventure in the Nature of Trade, and it's legal speak for a business project. So when Revenue Canada can't make the case that you're in the business, in the real estate business, then they jump to this argument that you're running a business project. And this is typically used a lot of times when someone has a rental property, and when they sell the property, technically they only have to pay tax on half of the gain, which is called a capital gain, rather than paying tax on the whole gain, which would be under business income. And so this is Revenue Canada's way of reclassifying your capital gain into business income, so you have to pay tax on the whole gain rather than on half of the gain. Gotcha.
Okay, so basically we're looking at an investor that owned a bunch of properties for many years, rented them out, did the positive cash flow thing, and then filed his taxes, paid capital gains on his income tax return, and then, years down the road he gets audited, CRA says, no, you shouldn't have paid just capital gains, it was business income, which effectively doubles your tax bill, is that right?
Exactly, absolutely, and on top of that it adds interest. And they justify it by calling it a business project, because a business project, there's no definition of how short or how long it is, how much involvement there is, and so it really becomes a large gray area and allows them some wiggle room in terms of making technical arguments.
I can imagine, Surinder, you must get clients that this has devastated their life.
Yes, you're absolutely right, Joe. Because if you take a look at the price of real estate nowadays, and if you own a property for many years, or if there's a short-term increase in market prices, then the gain that some people can realize and be taxed on, it can be much larger than their annual incomes. And it can be quite demanding for them to have to try to come up with such a large amount of funds all at once.
I know your firm focuses on representing high-profile tax cases against CRA, but looking more at the average Joe sort of client story, something that represents more typical Canadian real estate investor and how CRA attacks them with this ant argument.
Sure, absolutely, Joe. We see this all the time. The most recent case that comes to my mind was a client who was a BC government employee. He had a very good job, and so he was able to save some money and use his savings to buy real estate. And so he had 3 rental properties, and over the course of 2 years, he had decided to sell 2 of them. So in year 1, he sold the first property. In year 2, he sold the second property. And both years, he filed his taxes on time, and he showed the capital gain on his tax return through his accounting firm. And ultimately, Revenue Canada comes along and uses this business project / ant argument on him, and says, look, you need to pay full business tax on these gains. And so he was quite devastated, because the gains and the taxes that were produced and the interest on top of the taxes was a lot more than his annual income.
So we talking hundreds of thousands of dollars, his reassessment?
Absolutely, Joe.
And roughly how many doors did he own? Do you recall?
So at that time, he had 3 rental properties. He had sold 2 of them in those 2 years, And what he did, though, is once he sold one, he used that money to buy another rental property. So he kept 3 rental properties at all times. So Revenue Canada was saying, you're in the business of flipping properties. And being in the business of flipping properties, therefore you should have to pay business tax, which is 100% of the gain. He sold and purchased another property, and the second year he did the same thing. He sold and then purchased another property with the proceeds of sale. Revenue Canada says, well, we've got a series of forced buys and sells here, and now we're going to say that you were running a business project over the 2 years.
Right. Okay. So they've got a good handful of arguments to put a real estate investor into the ant box, don't they? I know rent to own is one of them. They say, hey, your intention was to sell the property right away because the rent to own is a lease option to purchase. So that's one of them. This guy was a flipping situation, and then they try to just lump all your real estate into one box. Is that right? Even though you just might have flipped a couple of the properties.
Absolutely. Whenever you've got multiple rental properties in your portfolio, Joseph, what happens is Revenue Canada sees those properties not as investments like you see them. How the auditor can see them as inventory in a business. And so they see things differently than we do. And when you've got an auditor who's looking at things, trying to figure out how do I justify increasing your tax bill, then these sort of issues give them a method to be able to justify to such a conclusion.
Right, right. Can you share with us this client, this BC employee client? What was it like? What was his life like when he came to you, and then how did you help him out? If you could share that with us.
Well, Joe, he was just like the rest of us. He had a very well-paying job. He was a manager in the BC government, and he was quite happy. The family's happy, wife, 2 kids, living in the average house. And so all of a sudden one day he gets a letter from Revenue Canada after filing his tax returns saying that, we're reviewing your tax returns that you filed over 2 years ago. And it was out of the blue, it was unexpected, and as soon as he saw the numbers, he was quite worried because he thought, how am I going to pay this bill, first of all? Secondly, the thought comes into his mind, how is this even justified? I show my taxes, I show all of my income, I file my taxes on time, I'm a government employee on top of it, and so he was confused as to how our Canadian government can do this to him.
Oh, yeah, I can imagine. You said, again, it was a bill for hundreds of thousands of dollars he got in the mail, right?
That's right.
Oh, I can imagine. That's devastating.
Justifying their conclusion that this was a business project.
Right, and he's a full-time employee, and he just has some rental properties on the side.
Yeah.
And they deploy the ant on him and send him a couple $100,000 tax bill. How fair is that? Wow. Yeah,
emotionally, just like the rest of us, we all love Canada. That's why we're here. And that's why we invest in Canada, by buying real estate. And so all these emotions come into your mind at that time, Joe. How can my government do this to me? I'm a good Canadian citizen, and now I'm being treated as someone who's done something wrong.
Well, that's great, Surinder. Thanks for sharing about that, average Joe client and what their situation was when they came in to see you. Now, how did you help them out?
So, Joe, what I was able to do is sit down with the client. I interviewed them and analyzed their situation. Ultimately, I prepared a reply to Revenue Canada's proposal letter, and in the reply to the proposal, I was able to justify why that this client's activity was not applicable to the ant argument, and therefore I was able to justify why it should have stayed as capital gains tax the way he had originally filed his tax return, and therefore blocked them from reassessing it as business income.
What was the end result that you obtained for your client in this case?
Ultimately, I was able to negotiate and sit down with the appeals officer and get them to agree that to leave it as capital gains, and they vacated their assessment to make it business income.
Well, that's fantastic, Surinder. So you basically got a hundreds of thousands of dollars of a tax bill for a taxpayer reversed.
That's right, Joseph. We do this on a regular basis. This is what we do.
Now, Surinder, what do you suggest investors do when they get that dreaded letter in the mail? It's basically a proposal of reassessment. They're deploying the ant, and they're saying, hey, you filed this as capital gains, you sold these property. We're saying it's business income under the ant. What do you suggest they do right from the get-go when they get that letter of proposal in the mail?
Well, Joe, I would say as soon as you get any letter from Revenue Canada, especially the initial letter telling you that you're being audited, I would take that right away. Take that to someone who can represent you, whether it's an accountant or a tax lawyer, depending on your situation, and sit down with them and get that person to represent you. You want someone who's got experience dealing with CRA. You want someone who understands not just how to file tax returns, but also understands the tax law. The Income Tax Act is quite complex, and you do need an expert to represent you in how to deal with CRA, because a lot of times I've seen real estate investors say, hey, look, I'm an honest person. I've got nothing to hide. Why don't I just sit down and talk to these people myself? Everything will be okay. Unfortunately, the Revenue Canada world doesn't work like that. You really need someone who understands the law to sit down with them and be the buffer and be your representative.
So basically, don't face them alone is the moral of the story here. They know the questions, they know what they're digging, right? They're on a mission and they're trying to get you to say certain things, and you don't even realize you don't know what you don't know, sort of thing. What can be used against you?
That's a very good point, Joe. You don't know what you don't know.
Mm-hmm. Okay. Our intent with this thing is not to slam the CRA as much as it is to more of an empowerment, which is leading into my next question. How can real estate investors, what can they do to help avoid getting eaten alive financially by the CRA's ant, real estate investors? So if you could give us some of your best tips that Canadian investors can do right away to help ensure, I know there's no guarantees, but to help ensure this doesn't happen to them.
The issue here is that Revenue Canada or CRA has a duty to make sure to protect the integrity of the tax base, is how they put it, so that every one of us who pays our taxes properly, it's not fair to us if someone's out there cheating the system. And so that's why they do what they do. But in terms of this ant argument, the main issue is you have to take a look at your circumstances. And the number one criteria is the length, the period of ownership. So generally a property that's owned for a longer period of time, especially if you've rented it out, it's harder for them to argue that it was inventory and that it was a short-term business project if you've owned it for a longer time period. So the question is, do you buy and hold, or are you a flipper who has a large frequency of buying and selling properties within a short time period? And so there's nothing wrong with either plan. Either you have an investment plan of buying and holding for the long term, or you have a business plan of purchasing and selling properties within a short time period. So it all depends on how you file your taxes and how you conduct yourself from a tax standpoint. So if you want to legitimize, nothing wrong with legitimizing the business of flipping, and in that case, I would recommend that you get a business number and then declare, hey, I'm in the business of flipping property. So by getting a business number, a GST number, when you purchase a property, then it really simplifies a lot of things for you, in that you don't have to technically pay the cash flow that's required. Let's say you buy a property on which GST is applicable, then you wouldn't have to pay the GST to the seller. You can self-assess, which allows you to declare that to get credit for paying the GST without actually having to pay it, because you also get an offsetting credit on your GST return. And so that can save you a lot in your purchase price. And then when you sell the property, same thing. You're declaring that you're in the business of flipping property. Now I'm completing the other side of my transaction by selling it.
And just to clarify, if you're a flipper, there's pretty much no way out of that income being classified as business income, correct?
That's absolutely correct.
Right.
However, as a flipper in the business of flipping, then you're also entitled to business expenditures.
I got you. So you're saying put yourself in the business box right there. If you know you're a flipper, file your tax returns as a flipper. It's business income. Set yourself up as a business, and that way you can write off the expenses.
Absolutely, Joe. And you're being honest about what you're doing. And that's all the tax department cares, is that when we file our tax returns, how we file reflects what we're actually doing in the real world.
Okay, thanks for that. Now, what if somebody's more of a buy, hold, and prosper type investor? They're acquiring doors over the years, and they manage it for an average of 10 years. They've got long-term holds. They rent out the properties themselves, or they use property management. I don't think that matters. What can an investor do to help prevent the possibility of CRA classifying them as business income and deploying the ant on them?
Very good question, Joe. What I would do in that situation is make sure I keep all of my records. So records you can categorize into 3 different phases. Phase 1 is of real estate property, and so you'll have your statement of adjustments is the key document that they want to see. So that's the document that your lawyer gets on conveyancing. In addition, you'll have your real estate contract for your agreement to purchase the property. So any document that you've been given on purchase, make sure you keep that in a folder labeled purchase of XYZ property with the address on it. And number 2 is the holding period. So, for example, if it's a rental property, you want to keep track of all your rental income and your expenditures as well. So keep receipts from keep the receipts, a copy of your copy of the receipts that you give to your tenants for rental income that you receive, or keep a copy of your bank statement in that folder and highlight the deposits that were rental income. Most importantly, maintain a separate bank account for those deposits. So have a separate rental bank account where you deposit rental income and pay your rental expenditures out of. And thirdly, keep your receipts for your rental expenses. And so whether it's a small expense, a minor repair, or a major renovation, keep those receipts. In addition, same with your property taxes and your mortgage interest, keep your statements for those expenditures. And third, the last thing is, have an investment plan. Put it in writing. What are your goals? And I would make that specific for each property that I own. I would write down, okay, here's my property on Main Street, and my goal is to realize a capital gain over 10 years, and in the meantime, I'm going to have the tenants pay for my mortgage by renting it out. That sort of thing. So sit down with an investment planner or your real estate advisor and write down a plan.
Right, and that intent, we were speaking before off air, that intent, isn't that one of the most important things that CRA looks at?
Absolutely, Joe. You're totally right.
So write a business plan out as close to the day that you purchased the property as possible. One technique I've used is to mail it back to yourself, leave it in a Canadian, stamped, it's got Canada Post stamp on it to time stamp it, and then if you ever called upon, you can prove that was your intent on the day of purchase.
Absolutely right, Joe. And there's multiple ways to verify the date and time. You can have it notarized, you can have it witnessed by your investment advisor, and whether it's an investment plan or a business plan, the key is that you put it in writing.
Right. Now, Surinder, say I've got some properties in my portfolio that are negative cash flow, some are substantially positive cash flow. There's taxes owed on that income, on that cash flow income. Is there a way of minimizing the taxes on that? Definitely,
Joe. What can happen is when you've got a property with positive cash flow, your accountant can take the depreciation on the building. Now, you as real estate investors don't think that the value of a property goes down over time, and obviously it goes up. However, from Revenue Canada's point of view, they separate your property into 2 portions, the land portion and the building portion. Land always goes up, everybody agrees. However, for the building, Revenue Canada and the income tax law allow you to assume that the value of the building is going down because it's a depreciable asset that's eroding. And so what happens is the tax law has prescribed 4% of the cost of your building that you're allowed to take as depreciation. However, you can only take it when you have a rental profit. You cannot take it when you've got a loss, and you can't create a loss with it. You can only make your rental income zero by deducting it and offsetting it against your rental profit.
Excellent.
So that can be a very helpful strategy when you've got rental profit and you don't want to pay the taxes now. You can defer the taxes later on until you sell the property.
Right, okay. Another question. I was talking to an apprentice, one of my first apprentices, way back 15 years ago, and he's retired now with his positive cash flow from his portfolio in Ontario. He does student rentals. And so we were chatting about this ant argument, and we both came to the conclusion that, hey, what he's going to do is he's just going to refi all his properties. He's going to remortgage them as much as he can, take that capital, and he can spend that capital, do whatever he wants with it. How does that strategy, is that strategy good to prevent the ant?
Not really, Joe. And the reason is that the tax law takes a look at what you used the refinance, the mortgage funds that you took out, the equity takeout that you did, what did you use those additional funds for? If they were used to purchase another property or they were used to renovate any of your existing properties, then fine, the interest on those funds is deductible. However, if you used it for some other personal purpose, then the interest on the additional funds is not deductible against their rental income.
Gotcha. Yeah, the interest on the loan. Yeah, if it's used for personal stuff, it would not be taxed. It would be. So if it's used for personal stuff, it would be taxable.
Yeah, no. Yeah, if it's used for personal purposes, the interest on the loan is not tax deductible.
Oh, the interest, yes. But I'm talking about say he refis it and puts $300,000 cash in his pocket. It's a refi. There's no way CRA can make that business income, correct?
Oh yeah, exactly. It's not business income, nor is it deductible.
Okay. So that's what we mean. Instead of selling the property, he would just refi it to get some of his profits out.
That's right. Yeah, he's done an equity takeout, and technically, since these are funds borrowed from the bank, they're not income, so therefore they're not taxable.
I know this brings upon another point. I just thought I'd get your 2 bits on this. From past experience, I've learned that whenever you take money out, you refi your property, and say you get a $100,000 equity takeout on a property. Very important, if you plan on investing that money in whatever, so to be able to declare the interest as
an expense.
Expense, thank you. Very important that you use all of that money to invest it. If you have an account with that $100,000 goes into, and you invest, say, $50,000 of it, and from that same account, say you put it in your family account, where your mortgage comes out of, your groceries and stuff like that, sort of commingling the funds, CRA can attack you and say, well, they can overturn your ability to
deduct the interest.
Exactly. What's your thoughts on that?
And what happens is, by commingling the funds, Revenue Canada will say to you that we cannot, that your paper trail and your actions are not clear as to what business purpose the funds were used for. And so once there's any sort of doubt that the funds weren't entirely used for business purposes, they deny all of the interest. And they put the ball back in your court to justify it.
Right. In a lot of cases, investors lose out on that, right?
Absolutely. I've seen many, many cases over the years when I was an auditor, and in the 13 years of working with CRA inside and outside of CRA, that many investors lose out where they're not able to deduct interest that otherwise should be deductible.
Mm-hmm. Yeah, that's a very important lesson.
Definitely. And you really need someone to be able to explain that to them, and to be able to trace where the money went and how much of the interest should be deductible, by virtue of explaining how much was actually used for real estate investment purposes.
Right. So to distill everything down here in this interview, the moral of the story here is the tax implications as a real estate investor is way too important to abdicate your education, your responsibility. Don't just leave it up to chance, or you might just be wiped out. It's happened to many real estate investors. You need to take charge, take the bull by the horns, and educate yourself on tax law and the implications as a real estate investor, would you say?
Yeah, and if you don't have the time to educate yourself on the tax law, then find an accountant or a lawyer who does.
Exactly. Well, I suggest people do both. Don't abdicate completely to a professional, but have a base level of knowledge yourself. It's just one of those areas of expertise I find that real estate investors are pretty much clueless about until it bites them in the ass one day.
That's a very good point. You're totally right. Whatever you're getting into, whether it's real estate investment or whatever game you're playing, always be knowledgeable about what you're doing and try to understand every aspect of it. And any part, and a big part of any business or investment is risk management. And I think in terms of what CRA is doing with this argument, it behooves us as real estate investors, in terms of our risk management, to understand, what is Revenue Canada trying to do? What is their point? How do I protect myself? If we don't ask these questions, we leave ourselves open, just like sitting ducks.
Mm-hmm. Excellent point. Well, that's excellent. Is that all the tips you're going to share with us today, or do you have any more?
I think we've covered the key issues, Joe. One more issue I think that's quite important in terms of expenditures is that we need to take a look at what is a current expense and a capital expense. And I know Revenue Canada brings this up in many, many audits. I would say a large percentage of them. And in terms of current expense is something that happens, not frequently, once in a while, and it provides a short-term benefit. It's sort of like in a rental property, doing a minor repair. And so the plumbing, that sort of thing. But something like a renovation is a capital expense. It provides a long-term benefit, and it's going to last many years. And it only happens once in a while. Usually, it's a larger expense. And so, what happens is when you file your tax return, the major renovations, the capital expenditures, have to be depreciated over a longer time period. You can't write them off all at once. The current expenses, those ones you can write off all at once against the rental income that you receive, and therefore they reduce the taxes on the rental income. And so the capital expenses, because they provide a longer benefit, a long-term benefit, you can only depreciate them and write off a smaller portion each year. So your tax preparer will be knowledgeable. Make sure you have a tax preparer who's specifically knowledgeable about how to prepare taxes for rental properties and for real estate investors, because it is a separate area of the tax law. And it's very important for you to have someone that's specifically knowledgeable, because most accountants out there are knowledgeable and trained when they get their CGAs and their CAs designations. They're more trained in how to prepare taxes for business owners, and there's not as much in-depth training on how to prepare taxes for people with rental property portfolios.
I think that's excellent advice, Surinder. Thank you very much. I know I've certainly learned in the trenches over 19 years of being an active real estate investor. It's hard to find an accountant that specializes in real estate, right? Because there's a lot of expert specific knowledge that your average chartered accountant just doesn't know, that can save you thousands and thousands of dollars. So it's an invaluable member on your power team. And believe me, not having an expert accountant that specializes in real estate can make or break your real estate investing career, especially once you're up at, a large, sizable portfolio. First of all, they minimize your tax burden because they understand the Canadian Tax Act as it pertains to real estate and real estate investors. So it's minimizing your tax burden, and every dollar saved is a dollar back in your pocket, right? And second of all, they position you to minimize your chances of being attacked by the killer ant argument from CRA and other arguments, right? So, as they say, an ounce of prevention is worth a pound of cure. So this is one of the hardest, most undervalued power team members, I find, that real estate investors just don't see the significance of it enough until and if, like I say, it comes back to bite them. CRA comes after them. So on that note, I went to Surinder and I said, Surinder, our subscribers, Canadian real estate investors, really need your firm, both the accounting and the tax defense side. So can you make a special offer for them? Is there any way you can do something special for them? And he was very gracious and came back with 2 special bonus offers that only subscribers of CanadianRealEstateWealth.com get. So here goes. Bonus number 1. For accounting services, he will give you a free consultation as long as you're considering moving your business over to him. And you can ask him all your personal questions about your situation and sort of take him for a test drive. Bonus number 2. If you find yourself in a situation where you're going up against CRA, they have attacked you somehow, either notices of reassessment, proposals of reassessment, letters in the mail, overturning large expenditures, you name it. There's all kinds of things they could be coming at you with. If you need to go up against CRA, Surinder is your man. He works together with a lawyer, and he knows the act inside and out, especially as it pertains to ANT and Canadian real estate investors and how to defend against all kinds of arguments, ridiculous in my opinion, and frivolous arguments I've seen out there. Surinder takes the bull by the horns. So bonus number 2 is he will give you a free consultation if you have a tax situation where they're reassessing you over $100,000, over 6 figures. Normal, his threshold is $250,000, but again, he's brought it down lower because I said, you know, your average Canadian investor isn't that sizable, so can you do something special for us? And he graciously did. Now, to take advantage of either bonus number 1 or bonus number 2, it's super simple. You must be a subscriber to CanadianRealEstateWealth.com, but it's free right now for 1 year for a limited time. Go to the website in the upper right corner, click the subscribe button. Then you send us an email to info@CanadianRealEstateWealth.com. If you're looking for the free accounting consultation, simply put free accounting consultation in the subject line, and we will forward the email to Surinder. Bonus number 2, if you're looking for the tax defense free consultation, put in the subject line, free tax defense consultation. And again, we'll forward it to Surinder. And the other thing Surinder and I are going to do is there's been a lot of demand. People have a lot of questions. They're asking us a ton of questions. So we're going to have a free webinar as well where Surinder and I are going to be on. I'll host a webinar, and you can ask him any particular questions that you have as pertains to your portfolio, your personal situation, free of charge. And lastly, Surinder, I wanted to sincerely thank you from CanadianRealEstateWealth.com and myself, first for your generosity. I mean, that was an incredible gift that you gave to all our subscribers, a complimentary consultation both on the accounting side and on the tax defense side. Thank you very much for that. And on a personal note, I just want to convey to you that I fervently believe in your cause. You know, I think the community of Canadian real estate investors has been needing somebody like you. You filled a void that's existed for a long time. Somebody that is a consummate expert in the Tax Act, that has experience as a former CRA auditor. You know how the inner workings are on the inside, still have some connections there. And somebody that can go to bat for the little guy real estate investor that gets squashed with the ant, like your example of somebody you defended there that had 3 properties and was reassessed hundreds of thousands of dollars that could have ruined his family, could have ruined their life. I very much appreciate the service that you bring to the community and your expertise and for providing your time here today. Thank you again.
Thank you, Joe. I really appreciate you saying that. I really love what I do, and I love working with real estate investors.
Yeah, I know. I can tell, having talked to you for months here, you truly do care. Thanks very much, Surinder.
Thank you, Joe. I appreciate it.